In the pre-dawn hours of a humid Wednesday in Hanoi, as the city slowly stirred to life, a factory manager for a major sportswear brand sat alone in his office reviewing production schedules. Suddenly, his phone buzzed with a news alert, one that would upend not just his day, but the future of his company's global operations. The message was brief, but its implications were seismic. As he read, a wave of anxiety swept through the factory floor. Workers and supervisors exchanged worried glances, sensing that something monumental had just happened, something that would ripple far beyond the factory walls. Thousands of miles away, in the marble halls of Washington, D.C., lawmakers had just announced a sweeping new policy, a 20% tariff on all goods imported from Vietnam into the United States, effective immediately. The news flashed across global financial networks, catching businesses and governments off guard. This single act, announced by President Trump on July 2, 2025, instantly redrew the economic map. It sent shockwaves from Vietnamese assembly lines, where workers now faced uncertainty about their jobs, to bustling American shopping centers, where retailers scrambled to assess the impact on prices and inventory. Years of careful supply chain diversification, especially the much-touted China Plus One strategy, were suddenly in jeopardy. Billions of dollars invested in Vietnam's manufacturing sector now hung in the balance, as executives in boardrooms around the world pored over supply chain maps, searching for answers and alternatives. The ripple effects were immediate and far-reaching. Factory workers in Vietnam worried about layoffs while corporate leaders debated emergency strategies. On Wall Street, traders reacted to the sudden uncertainty, and American families wondered if the cost of everyday goods would soon rise. The resilience of the modern global economy was about to be tested in ways few had anticipated. This is the story of how a single decision in Washington sent tremors across the globe, exposing just how deeply interconnected and unexpectedly vulnerable our world has become in the 21st century. The new U.S. policy is sweeping, marking one of the most significant trade moves in recent years. It's not a targeted measure, but a broad, all-encompassing action that's sending shockwaves through global supply chains. The United States has imposed a 20% tariff on every single import from Vietnam, blanketing all categories from textiles and electronics to furniture and footwear. This isn't just about a few select products, it's a comprehensive tariff that touches nearly every item shipped from Vietnam to American shores. In 2024 alone, Vietnam exported a staggering $127 billion worth of goods to the U.S. With the new tariff, an estimated $25 billion in additional annual costs will now ripple through the supply chain, affecting everything from raw materials to finished goods on store shelves. Every container, whether it's packed with high-end electronics, affordable furniture, or the latest smartphones, now faces a tax equal to 1/5 its value. This means higher costs at every step, from the factory floor in Vietnam to the checkout counter in the U.S. The policy goes even further, slapping a punitive 40% tariff on goods that are trans-shipped from China through Vietnam. This move is designed to close common loopholes, making it much harder for companies to sidestep tariffs by simply rerouting products. With almost no time to adjust, companies on both sides of the Pacific are scrambling. Importers are frantically recalculating costs, retailers are debating whether to absorb or pass on price hikes, and Vietnamese manufacturers are bracing for reduced orders and potential layoffs. The ripple effects are immediate and far-reaching, impacting American consumers, business owners, and workers in Vietnam alike. In exchange, Vietnam has agreed to eliminate tariffs on a handful of U.S. products, such as certain agricultural goods. But these concessions are minor compared to the sweeping scale of the new U.S. levy, offering little relief to the broader trade relationship. While the U.S. Treasury stands to gain an estimated $11 billion in net revenue from these tariffs, that sum is dwarfed by the much larger disruption now unleashed across industries. For businesses and consumers alike, the true cost of this policy is only beginning to unfold. For America's biggest brands, the new tariff is a direct hit, one that's sending shockwaves through boardrooms and supply chains alike. These companies, household names with global reach, have spent years building intricate networks to keep costs low and shelves stocked. Now those very strategies are under threat. Take Apple, for example. After moving much of its iPhone and iPad production to Vietnam to avoid earlier tariffs, the company now faces billions in extra costs. up to $84 more per iPhone, and $1.6 billion more for iPads. These aren't just numbers on a spreadsheet, they could mean higher prices for consumers, squeezed profit margins, and tough decisions about where to manufacture next. Nike, which sources 43% of its shoes from Vietnam, is in a similar bind. The cost to make each pair will jump by nearly $5, a seemingly small amount that adds up to millions across their product lines. For shoppers, that could mean paying more for the latest sneakers, while Nike must weigh whether to absorb the hit or pass it on. Apparel giants like Gap and Old Navy are staring down $190 million in new costs, while Walmart, America's largest retailer, will pay $480 million more for goods sourced from Vietnam. These increases threaten to ripple through the entire retail sector, potentially raising prices on everything from jeans to home goods. It's not just clothing and shoes. Tech leaders like Dell and HP, along with the U.S. furniture industry, are also reeling. Tariffs are fueling price hikes on laptops, desks, and more, adding to inflation and making it harder for families and businesses to afford essentials. Now, these companies face a tough crossroads. Should they absorb the costs and risk shrinking profits, raise prices and risk losing customers, or move production yet again? An expensive and disruptive process? Each path comes with its own set of challenges and uncertainties. The safe haven Vietnam once offered is gone, replaced by a new source of risk and unpredictability. Companies that thought they'd found stability are now scrambling for alternatives. For America's corporate giants, the tariff isn't just a new line item. It's a fundamental threat to business models built over years of global planning, forcing a complete rethink of how and where the world's biggest brands do business. The real impact of the Vietnam tariff lands at the checkout counter. As companies pass on costs, Americans will pay more for everyday goods, electronics, shoes, furniture, even groceries. Expect iPhones to jump by $80 or more, Nike trainers by $6, $10, and furniture by at least 4%. Coffee and seafood, major Vietnamese exports, will see price hikes. Coffee up 12%, shrimp up 8–10%. These aren't luxuries, they're staples, and the increases hit lower and middle-income families hardest. Analysts predict the tariffs will add 0.3 percentage points to U.S. retail inflation by year's end. What was meant as a tool of trade policy now functions as a regressive tax on American households. The cost of global politics is about to show up on every receipt. For Vietnam, the tariff is an economic earthquake. The country's rapid growth, built on foreign investment and U.S. market access, is suddenly at risk. The World Bank predicts a 1.6-point drop in GDP growth, slowing Vietnam's economy to just 4.2% in 2025. The dong is expected to weaken, fueling domestic inflation as imports become pricier. Job losses could reach 300,000, especially in garment, footwear, and electronics sectors, threatening the new Vietnamese middle class. Billions in planned foreign investment are now on hold as companies rethink expansion. The trust and predictability that made Vietnam a manufacturing star have been shaken overnight. Vietnam's status as the world's China +1 destination is suddenly in jeopardy. The tariff has triggered a frantic search for alternatives. Companies are racing to shift production to Indonesia, Bangladesh, India, and Thailand, each with its own challenges. Bangladesh is seeing a surge in apparel orders. India and Thailand are attracting electronics investments. No single country can absorb all of Vietnam's volume, and each presents trade-offs in cost, infrastructure, and bureaucracy. Even European brands are looking to Latin America to bypass tariffs and shorten shipping times. The scramble exposes the fragility of concentrated supply chains and the urgent need for greater geographic diversification. The Vietnam tariff is a harsh lesson. In a volatile world, flexibility is survival. The global manufacturing map is being redrawn in real time. The shockwave from the Vietnam tariff hits America's allies hard. South Korea, Japan, and Taiwan have invested billions in Vietnamese factories, using them as key export hubs to the U.S. Samsung, and LG face billions in lost revenue. Japanese brands like Panasonic and Sharp are hit with hundreds of millions in extra costs. The tariff taxes South Korean and Japanese innovation simply because final assembly happens in Vietnam. For Taiwan, the impact is also significant. Foxconn and others now see their diversification strategies undermined. The policy punishes companies that followed U.S. advice to diversify away from China, creating confusion and eroding trust among allies. Economic collateral damage is straining relationships in the Indo-Pacific. The tariff's reach extends far beyond its intended target. The tariffs' impact ripples through shipping, logistics, banking, and insurance. Major ports like Singapore brace for a 15% drop in U.S.-bound cargo. Shipping lines and fuel suppliers face hundreds of millions in lost revenue. Insurance premiums for Vietnam-origin cargo are rising, squeezing exporters further. Global banks are downgrading forecasts as trade financing demand drops and credit risks rise. Even a single company's decision to shift from sea to air freight can move hundreds of millions in revenue between countries. The tariff has thrown a wrench into the finely tuned machinery of global trade, creating friction and uncertainty at every turn. The Vietnam tariff is a costly lesson in global economics. Intended to address a trade deficit, it instead disrupts supply chains, penalizes allies, destabilizes Vietnam, and raises prices for Americans. The true cost goes far beyond the $25 billion in duties. It's felt in lost jobs, stalled investments, and eroded trust. American companies face higher costs or the pain of relocating production. Vietnamese workers face lost livelihoods. The policy undermines the very supply chain resilience it was meant to encourage, sending mixed signals to partners worldwide. In a connected world, isolationism is an illusion. The path to prosperity lies in navigating complexity, not building walls.